Well, good evening, everybody. Elliot Katz here. The market's grinding higher, just like we talked about in the newsletter. As long as there's money around, the monetary conditions are favorable, the fundamental conditions are favorable, the market's going to grind higher. So even on a day like today, and if we could just pause and just pray for those families who lost loved ones in the Las Vegas massacre, and pray for those who are injured to speedily recover. So it doesn't look like much can hold the market down, even though today was not the most exciting day. You know, the market was up, the Dow was up like $100. 100 points. But the truth of the matter is that the market was, if you look at the percentages, there really wasn't a lot going on in the major indexes today. The action again was in the smaller cap stocks. Now, for us, a lot of the stocks that are the smaller ones tend not to have weekly options. So if we do find something that's liquid enough in that small cap space, we'll certainly consider it. But I'm not sure we're going to have opportunities just showering down on us. Okay, doesn't mean that we won't be able to do things. There aren't going to be opportunities in the larger stocks still, right? But I wanted to start today with a review of what I talked about in the newsletter about this Tractor Supply Company. This is a trade that, let me get my Word document copy of the newsletter and I'll show you what I'm talking about. Got to wait for it to come up. All right, so this is really the kind of stock that I like to look for opportunities in. The stock that's gotten hit, it's coming off the bottom. The moving averages are starting to flatten out and turn up a little bit. And on this, whatever you want to call it, a right-hand shoulder, maybe there's two lefts here, a right here on the head and shoulders, reverse head and shoulders pattern. Maybe you look at this resistance level here, whatever. When things like this start lining up, this is where I start getting interested. So on September 7th, which was right there, right at that point, right there, okay, I started a trade in the educational portfolio where we purchased the October 60 call for 285 and we sold the September 15 61.5 call for 90 cents, creating a bull call diagonal spread for a starting net debit of $1.95. So that was right there on the 7th. Is that it right there? Right there on the 7th. Okay. Now the stock, as you could see, it moved up and we were able to do some rolls to the 62 call, roll up and out. I'm sorry, we rolled to the 61.5 call. It was the September 22nd expiration. So we rolled this a couple of times. We rolled the 61.5 short a couple of times, and we lowered the cost to $1.15. Okay, so the second roll came on Friday, October 22nd. That was our final roll. Let me show you where that is. That's this Friday right here. Right there. Okay, which was on a very nice nice pullback. So the roll down to this, the roll to the 61.5 from the 61.5, getting our cost down to $1.15. And with the stock closing at 61.12, we were actually in pretty decent shape because we had a 61.5 call spread that was only costing us $1.15 with a long option expiring on October 17th. So we had almost a month to go, which gave us plenty of time to collect premium. However, on Monday, the stock popped and it was holding, but not making much progress. Well, this presented us with a very interesting situation because the stock was hovering around 63. So if we were going to roll to next week's 62 call spread, to next week's 62 call, we could have done that one for even money, but it wouldn't have lowered our net cost, but we would have widened the spread by an extra 50 cents to the 60.62 instead of the 60.61.5. If we had rolled to the 61.5, we only would have been able to collect an extra 25 cents. That lowers our cost to 90 cents, but if the stock kept running, the spread would begin to close towards 150, which is the difference between the 60 that we're long and the 61.5 that we're short. So what we decided to do on Friday was we actually took the trade off. So we took the trade off for $1.95. That gave us an 80-cent profit, which is a 41% return on the original debit of $1.95 in 22 days. And we get to recycle the money. So the point in the newsletter in highlighting this trade was that sometimes, even though you have until, let's say in this case, October, before your long option expires, sometimes the way things are setting up, you look at the different rolls compared to where the stock is, and you just have to conclude that, hey, if I raise the strike price of my short, yes, I am getting more potential upside, but I'm not lowering my cost. Am I willing to accept that risk? On the other side is rolling to collect more premium, but keeping the spread the same width. Now, in that case, yes, we would have lowered the cost to 90 cents, but if the stock had kept running, as opposed to going back down, which is the risk in the first adjustment, the risk in the second adjustment, rolling across to the same 61.5 call, that risk was the stock continuing to run higher. And if you notice over here, since it was pushing up against this resistance, it could have easily broken out to new highs. And then where are we? Then we're chasing a stock that's close to 64, and there's really not much more we can do at that point. And for those of you who have been following, you know that that's the situation that we found ourselves in the Celgene trade, is that the stock just keeps running. We keep making adjustments, and the trade is profitable, but at this point, what I'm really talking about is for all the effort that we put in, and this is what happens. You know, the trade that started on August 30th at $6.30 net debit right now is only looking at maybe an 8 to 10% return on initial invested capital, the $6.30, even though the risk is way down to $2.95 from $6.30, which sounds really good. The problem is that when we look at our trade is we're long the October 135 call and we're short this week's 138 call. So this trade right now is only worth about $3.25. So there's your 30 cents. Oh, it's only maybe about a 5% return now. You know, and the thing that hurts about having a low return on your initial invested capital is that we've had the money tied up, you know, for the better part of a month. But, you know, all the other trades are showing the attraction of this style of trading. So You know, sometimes you get a scratch trade, sometimes you get a low return trade. But for the most part, you're going to really, these trades are designed to give you a high probability of making decent returns. So decent meaning, you know, we're in the 30, the 40% range on the initial invested capital. For instance, the lows right now, okay, we started this trade back in, it wasn't that long ago, September 12th, long the November 80 call, and short the September 22nd 79.5 call for $1.44. Well, now, over the last 2 weeks, we've actually rolled this short option twice, and we've actually gotten our cost down to 99 cents. Well, right now, the trade is worth about $1.25. Okay, I mean, $1.25. So if we're at 99 cents, we're up 25, 26 cents on $1.44 initial invested capital. So we're approaching 20% already, and we've only been at it for 3 weeks, and the stock actually looks pretty darn good. Let's look to the chart, and I think you'll see something that is very, very familiar. You could almost overlay the tractor supply chart with this chart. Again, same idea. We saw the double bottom here. We see the stock starting moving far enough away from the downtrend events with the double bottom put in. Now consistently above the 20-day moving average and the 8-day moving average. A little bit of a move back up to this resistance. A nice, we did this on the 21st. Where's the 21st? That Thursday right there. Right. What day did we start this trade? On the 12th. So let's go back to the 12th. Okay, where's the 12th? The 12th is right over here. This green candle right here. Stock had pulled back. You see that candle there? It pulled right down to the 50-day. Even though the stock was down for the day, it did pull all the way back, did recover. The next day was up. And the conclusion is that with Home Depot looking good, we go back to Home Depot, here you go. Home Depot really looking much stronger. This stock lagging the Home Depot a little bit, I felt we had some opportunity here. So we had a little back off, and now we're able to roll up to the 80 call, and now we've got the 80 calendar spread, and we'll see what happens this week. Stock did back off the highs a little bit. Best thing for us right now is for the stock to stay right in the neighborhood of where it is right now, right in that 80 neighborhood, and that will give us an opportunity to really collect some extra premium. We sold this option for 66. It's trading at $1.10. Right? Remember, our net cost is 99. So if the stock stays right here at 80.82, this will lose about 20 cents. What's our net? That we have a positive theta of 3 cents a day, so we're really not going to make that much because of the passage of time. So we would like the stock to back off a little bit here and give us an opportunity to do a nice roll into the 80. But even if we wanted to do it right now, we could roll to next week. Even though it's Monday, we wouldn't do it. We could capture 35 cents. If we wanted to roll this up now to the 80.5, we'd still get a very, very small 40-cent credit. So as time goes by this week, hopefully we'll be able to grab some extra premium here. The theta of our short being 5 cents, the theta of the one we want to go to being only 3 cents if we go to the 80.5. So we got a chance for that to expand just a little bit. So that's that. Okay. What else we got? Like I say, Celgene is a work in progress. AbbVie is probably going to be our first, even though we have over a month to go, this is going to be our first 100% loser since we started, which isn't too bad because we've only had one other losing trade, which was the JP Morgan, which unfortunately, shouldn't have been a loser because I hate to lose money. The Schlumberger, which we've waited so long for the stock to move back up, our net cost on this option is only $260 or so. So having sold the option today at 25 cents, we're actually starting to bring some premium in again. We're down to $2.41. So if the stock stays right here and we get out of this thing for about $3, that'll be about a 60-cent profit on I think it was a $3 initial cost. So that would be about 20%, which again is not bad, even though it's on a time basis, it is a little on the weaker side. The longer you hold, the longer you have your capital at risk, the more return you're going to want. But sometimes it just doesn't work out that way. TripAdvisor, I think we got lucky. We dodged a bullet here. Priceline was really took it on the chin last week, and it brought a lot of the other stocks with it in this industry. Here's our TripAdvisor. You can see it really started getting hit. Stock was up 45 cents today. It's having some trouble around the 50-day moving average right here, and the technicals are not the greatest. However, we do have our cost by selling this 42 call today for 50 cents. We actually got our cost down to $1.60. So we're actually in a good spot here. So basically, we'll still have a couple of more weeks after this to take in some extra premium. But you can see we started with this thing at $3.40. So you tell me. I know it's always better if the stock just takes off, but isn't it nice to be able to manage the risk so that you can try to earn consistent profits, right? And that's the magic behind this style of trading, is to use the properties of option pricing and option price behavior to increase the probability that you can make money, i.e. lower your risk, and be more consistent. Okay? If you're more consistent, you don't have to have big blowout returns. You're not relying on big blowout returns to carry the return of your entire account. In fact, I was listening to someone today, a proprietary trader, who said something. He said a lot of very interesting things. One thing he said was he was talking about putting money into something that was a little more speculative. And what he said was, I don't put money into things that are speculative. He's a day trader, unless I already have some book profits for the day, because he doesn't want to speculate with money that he hasn't made. He'd rather speculate and give back some profits than speculate before he has any profits in hand. I thought that was a very wise thing to talk about. He also said that even though he is a day trader and he tends to trade the news, so very early in the morning he's going through news and analyst upgrades and downgrades and changes. He's looking for some daily catalysts that he can trade. And he was talking about the fact that he'd be more than happy to talk from his trading desk, and we were able to see his trading screen. He'd be more than happy to talk all day, But he wanted everyone to realize that if he's not talking, it just means that he hasn't found anything, that there's nothing going on, and that you don't always have to trade. So one of the important things for everybody to understand is that yes, you're going to hear things on TV, you're going to hear headline things, the market's making new highs, oil's doing this, things are happening here, things are happening there. Just like he says, I'm going to say almost exactly what he says. The point is to make money. And if you don't see an opportunity to make money, the market could be up 10%. If you don't see an opportunity that fits your trading style or your risk reward tolerance, you're not going to trade, right? You look for something that makes sense. And when you find it, then you're going to go in and make the trade, right? Like last week, okay? Last week, who knew, right? I guess the guy who did it knew what was going to happen in Las Vegas, okay? But last week, let's see, where were we? September 27th, okay? So what was the 27th? It's my wedding anniversary. Yeah, right there. Wednesday on the 27th with the stock coming back above the moving averages again. See how it's coming around like this? The stochastics are moving up. MACD histogram lagging a little bit, but otherwise things are looking pretty decent. Okay, what we do here, we bought the November 62.5 call for $3.20 and sold this Friday's 65 call for 44 cents. Then all of a sudden, the news rings out, and no surprise, here's where the stock was this morning. But with all with all respect and condolences to the families, right? Las Vegas Sands, the company, people want to own this stock. So after the initial decline this morning, actually almost right down to the 50-day, the stock came right back up and it actually made a new intermediate high here. So our trade right here that we put on last week is actually showing about $41 worth of profit on a starting cost of 276. So we're almost up 20% already on this on a hedge trade, and our call is still slightly out of the money. Okay? So when we start playing these things, right, we're looking for opportunities that make sense. Okay, and we're going to stay with them until they don't make sense. Right? And if every once in a while, like in the Celgene or the AbbVie, we kind of get stuck, especially the AbbVie, we're going to get stuck. That's the nature of the beast. I'm sorry. They all can't be winners, right? But of all the trades so far, we've only had a couple of washes, and we've had one loss. So what we're trying to teach you here with these educational trades, which these simulated trades, and they are for educational purposes only, is that there is a method to using the concepts that we talked about in the class. Okay, so let's talk about a couple of new things here, things that are on the radar. Let's get rid of this. Okay, I want to talk first about Costco. Now, Costco is reporting earnings this week. Okay, the chart of the stock looks phenomenal. Right here. I'll show you. Look at that. Look how terrific that looks. Right there. Now, the earnings are coming out. It looks like the market is saying the earnings are going to be pretty good. Okay, people are willing to buy the stock into earnings. Okay, however, the earnings might also not be so good. So, how do you play this? Okay, this has always been my approach with this. If I wanted to take a trade in a stock like this, what I want to do is I want to do it as cheaply as possible, but still have an opportunity to make some decent money if the stock goes the way that I predict it to be. So here we are, we're looking at a stock. Stock's about what it closed today, 166. Okay. If the earnings are good, you could see the stock at 170. In fact, right now, looking at the 165 straddle, what's the mark here? The mark here is 212. The mark here is, so the market is expecting a little over a $5 range, maybe $5.35. So based on today's stock price, the option market is pricing in about a $5 move one way or the other. So here's a trade that you could look at for this week. If you want to play the earnings just for this week, you could do the 165, 170 call spread for less than $1. It's 90 cents. Let's say even if it is $1. So it's $100. If the earnings are good and the stock can get above 170, well, that's a $250 spread, right? So you more than double your money on that trade. If you wanted to get a little cheaper, you can do the 170, 172 and a half call spread for maybe 50 cents. That's a $200 profit if you're right, but the stock's got to get to 172 and a half. Now, an alternative construction would be to use the 167 and a half, 170 call. Okay, if you notice the volatility is a little less, so this is going to cost you a little bit less on a relative basis, right? In fact, the funny thing is this is going to cost you $1, and this trade only costs you 90 cents. So they're actually almost the same price, right? So here's the October, and if you want to go out a couple more weeks and we analyze this trade, there you go. The thing that I like about this platform like this is that you can go over here and you could say, hey, if the implied volatility stays the same, I know if the stock got to about 169, I would make $35 on my dollar. And if the stock got to 170 on any day after today, it looks like I'll make at least $53. So if you feel the stock could end up at least at 170 between now and October 20th, you know, based on this, if the volatility stays the same, that this trade would give you at least a $53 profit. Why? Because the magenta line is today, the blue line is the expiration day, and everything in between going up from the magenta line is how the trade will evolve, migrate up towards the expiration day value. And you could see that if we go into the day stepper. We'll do let's do a 2-day stepper. Let's see if we can do that. Maybe we can do a 4-day stepper. Let's see if we can. There you go. That's a little better. So let's do 5 of these. Okay, there you go. So this goes from October 2nd to the 6th to the 10th to the 14th to the 18th, which is almost the expiration date, right? And if I'm at 170, all you got to do is look down here and see how the profit potential changes. And that's what I was saying. As the stock, as time goes by, right, the later the stock goes up, the better off you are, which is a big difference from just buying a call, right? Because when you buy a call and you pay the extrinsic value, the later the stock moves within the life of the option, the less money you make, right? When you just buy an option, the quicker it moves, the better off you are, right? Because you don't have theta, right? You don't have the negative theta affecting you yet. But here, because you're on the good side of the trade, the theta is positive. So the later it gets to 170, the better. So here you're looking at a difference between $50 to $63 profit on a $1 trade. So if you wanted to give the stock a couple 3 weeks to move up to 170, that would be fantastic, right? That would be a great little trade. You pay $1 and with the potential to make $1.50. Not a bad little trade, right? But you got to believe that this stock has 170 potential, right? At least 170 potential, and that is over here, 170, right in here. So it's still below this resistance level, the bottom of the gap. So maybe it pulls up here to 170, pulls back. Then if it rolls past this on the next move, which is what is that price right there? Just a tad over 170. And what was the high on that day? Hold on, let me get it. 170.60. Right? Then you could move all the way up here and fill that gap up to 177 or thereabouts. So not a bad play at all. Not a bad play at all. So Costco's one that you could definitely look at for a bull calls, a cheap out of the money bull call spread. And we've got some other things on our watch list that we're looking at. We did have success in Lyondell Basel, one of our first trades, and Chemours is in the same industry. So we were looking at that today. Other stocks we're looking at, surprisingly, Disney looks like it might be coming around a bit here. And with earnings a little bit further out, I think earnings are out in December now. Early November, so we got a month out in December now. Early November, so we got a month here. Looks like the stock is starting to perk up a little bit. I was watching Akamai for a reversal to the upside, and the stock gapped up today, so I don't know what I'm going to do with that one. Earnings are October 24th. May have to just wait this one out a little bit, unfortunately. But those are the kind of stocks that we've got on the radar. Another one, AIG. Also coming around here after this bottom. Looking very good. November 1 expected earnings, so you got a month to collect premium on that. John Deere I've actually been following for a couple of weeks now. Haven't been able to find a trade that I like in it. And you could see it popped up again. At least this one has earnings around Thanksgiving, so any kind of pullback against this resistance is definitely a go, because the rest of the technicals look good. And last but not least, we talked about this last week a little bit, is AutoZone. And this is just one of those stocks where it is so expensive. It's so high priced that the real way to go about this is either through a straight up out of the money bull call spread, give this, let's say, November, give the stock plenty of time to move up. You see right here, this, you could see the stock, let's say at this resistance level right here. Let's put that in there. What is that? What's that high right there? 625. And then up here, if it fills the gap, we're looking at the low there is 667, so 665. So there's a couple of ways that you could actually do this. Let me get rid of the Costco trade. Right? If you really wanted to just give yourself plenty of time and you were really, really bullish on the stock, you could create these $10 spreads out here. Let me show you this one. I mean, it's going to take a while. I mean, the stock's got to go up $40 from here, which is what, about 7% by December. But here's a $10 spread that would only cost you $3.27. And obviously it has very, very low theta at the beginning. You will have a little bit of positive gamma, a little bit, as the stock moves up. And you're not going to have any real net vega, right? Because they're pretty close. The strike prices are pretty close, and they're far enough away in time that the vegas are pretty close, right? So you can pull one of those off, right? And as the stock moves up towards 630, what you'll see is, whoops, don't want to do that. Hang on, let me get rid of some of these. I got about a dozen of these things up here. You could see we're playing around with this. Whoops. Sorry, I got this the wrong way. Let me make this plus. And let's just go to the expiration day. There you go. So that's what it looks like. You can see it's pretty far away from the stock, but that's why it's cheap. So if you want to just spend $300 and wait for a few months and see where the stock's going to be, you can make some money out here, right? The other way to do it would be to do the broken wing butterfly spread. And let me get rid of this one. So when we looked at the chart, where we were saying there was some resistance up here at around 623. So what I was thinking is that maybe we'll start with the November 610, okay, like that. We'll sell twice as many 630s, and we'll buy a 640. And that's a $4.69 debit, but the strike price starts at 610. Our long is 610. Now, the cool thing about this is that the two spreads are two different sizes. Sorry. Let's do this. We're over here now. There you go. So you could see the spread we're long is a $20 spread now, and the spread we're short is a $10 spread. So even if the stock overshoots, we're still going to be in pretty good shape, right? And even though we have to wait until November, you could see that if we do some time stepping, let's get this. Let's try to make this. Let's try to get close to that shape. Whoops, right there. There you go. So you could see here, if the stock gets to 613, you're making about 130, 140 bucks on a $400 some odd investment. But if the stock gets up into that 630 range, you could see the profit really starts picking up. And if it overshoots, right? If it overshoots, you're actually making more money over here, which is not going to stay. It's not going to stay like that. Because if you go to the expiration, boom, it comes right down, right? Because this short $10 spread ends up moving towards its full value. So the broken wing butterfly, I think, is a cool way to position yourself in a high price stock where you can create some very interesting possibilities. So on a stock like AutoZone, you can use a cheap $10 out of the money spread, or if you want to bring your long closer to the money by using the broken wing butterfly, you can collect some money for that other spread that you sell right there and lower the cost a little bit. So the big question is, would you rather have the 630, 640 $10 spread for 327, or would you rather have the November 610, 630 $20 call spread for 469, but still be able to make over $5 if the stock went past 640, right? That's a nice trade right there. Okay, so that's what we got. Everybody have a good couple of days. I'll see you on, when will I see you? I will see you on Wednesday. You know where to get me, at Elliot@investingshortcuts.com. Good luck, everybody. Hope you're enjoying the education.